There was no unified theme in the markets last week. The Japanese yen was the weakest currency in the early part of the week on speculation of imminent Bank of Japan easing. But the yen then rebounded strongly as disappointing corporate earnings triggered sell-offs in equities. Meanwhile, the Kiwi, Aussie and sterling were boosted by different factors in spite of risk aversion. Buying of these three currencies in crosses kept the euro pressured against the dollar. The Canadian dollar, on the other hand, weakened after flip-flopping for a while. Looking ahead, we expect the yen to be back under pressure as the Bank of Japan announcement approaches. Also, employment data as well as ISM from the US will probably rock the risk markets too and trigger volatility in the Forex market. The October Federal Open Market Committee meeting contained few surprises. Policymakers decided to keep the Fed fund rates and QE3 program unchanged. Some positive comments were made regarding economic developments though. For instance, the committee upgraded its assessment of household spending to as advanced a bit more quickly in October from continued to advance in its September statement. Moreover, Richmond Fed President Lacker seemed to have changed his stance modestly. We expect the Fed to expand the size of its asset purchases by $45 billion in December, so as to maintain a constant pace of buying after completion of Operation Twist. The U.S. economy expanded at a pace of 2% annualized rate in Q3, compared to expectation of 1.8% and Q2's 1.3%. Meanwhile, the GDP price index rose 2.8% versus consensus of 2%. In the Eurozone, preliminary findings of Troika showed that Greece needs an additional 16 to 20 billion euros in funding, if the fiscal adjustment program is extended for 2 years. That's a bit higher than Finance Minister Stornar's estimate of 13 to 15 billion. An unnamed European official was quoted as saying that there is no chance Greece could bring debt down to 120% of GDP in 2020. Instead, it would be at 136%, under a positive scenario of a primary budget surplus, a return to economic growth, and privatization. And it's estimated that an additional 30 billion euros of additional financing is needed. To cope with the additional funding needed, an option is to reduce the interest rates on loans to Greece. Another option is to bring forward some payments from the IMF. Stornar said on Wednesday that Greece had already been granted the extension, but European officials have already denied that. The decision could be made at the net ECOFIN meeting in Brussels on November 12. Moody's downgraded ratings on 5 Spanish regions, noting that the downgrades were driven by the deterioration in their liquidity positions, as evidenced by their very limited cash reserves as of September 2012, and their significant reliance on short-term credit lines to fund operating needs. Eurozone PMI manufacturing unexpectedly dropped again to 45.3 in October, while services PMI just showed mild improvement at 46.2. Both were below expectations of 46.5 and 46.4 respectively. The composite PMI dropped to a 40-month low of 44.8. German PMI manufacturing dropped to 45.7 while PMI services dropped to 49.3. German IFO business climate dropped to 100 in October, the lowest since February 2010, while the current assessment index dropped to 107.3. The expectations gauge was unchanged at 93.2. This data clearly indicates that recession is set to continue in the Eurozone and Germany won't be immune. Speculation of additional easing from the Bank of Japan, as soon as on its meeting next week, intensified further. It's reported that bank officials are already discussing additional measures to boost recovery that include expansion of its asset buying program. Meanwhile, political pressure continues to be on the central bank. Seiji Mihara, the first minister to join a Bank of Japan meeting in nearly a decade, said he'd probably join next week's meeting again. Mahara said today that he hopes to continue calling on the bank to pursue powerful monetary easing to achieve at an early date its 1% inflation target. Japan's trade deficit widened sharply to 0.98 trillion Japanese yen in September from 0.46 trillion a month ago. The result was the worst on record and was mainly driven by the increase in imports and the huge drop in exports. Geographically, exports to mainland China declined 14.1% due to tensions between China and Japan on the Diaoyu Islands dispute. The economy probably contracted in the third quarter, hurt by deterioration in the exports sector. National CPI dropped 0.1% year-on-year in September, staying in deflation, while Tokyo CPI dropped 0.4% year-on-year. Though, both are better than expectation of a drop of 0.2% and 0.5% year-on-year respectively. After all, as Japan remains in deflation, the expectation for the Bank of Japan to expand its monetary stimulus next week in its October 30th meeting is high. There is still much to be done to achieve the 1% inflation target. And if it happens, it will be the second time the bank has expanded stimulus in 2 months. The UK emerged from recession and grew an impressive 1% quarter-on-quarter, compared to expectation of 0.6%. The data should have put additional easing from the Bank of England in Q4 off the table and will likely give sterling additional support in the near term. However, markets will likely remain cautious on sterling on a medium-term angle because once the so-called Olympic effect unwinds, the UK economy may go back to recession again. Bank of England Governor King said that he's still concerned if whether some of the recent more positive signs will persist. He noted that storm clouds coming from the euro area have not yet lifted, and China, India and Brazil are slowing. He pledged that, should those signs fade, the MPC does stand ready to inject more money into the economy. The Bank of Canada left its benchmark overnight rate target unchanged at 1% in October. Policymakers retained the view that some modest withdrawal of monetary policy stimulus will likely be required. The central bank also raised its GDP forecast for this year while maintaining and reducing the outlooks for 2013 and 2014 respectively. The statement gave the Canadian dollar a brief boost. But the Canadian dollar was back under selling pressure after the Bank of Canada's Governor Carney noted that the case for adjustment of interest rates has become less imminent. Australian CPI rose more than expected by 1.4% quarter-on-quarter and 2% year-on-year in Q3, compared to consensus of 1% and 1.6%. The Reserve Bank trim-meant CPI rose more than expected to 2.4% year-on-year and the weighted mean CPI jumped to 2.6% year-on-year. While the stronger-than-expected inflation reading isn't enough to change the bank's loosening bias, the data would give the central bank more thoughts before cutting rates again. And that reduced the chance of another cut in November. At the first meeting in his capacity as the Reserve Bank of New Zealand's governor, Graham Wheeler left the official cash rate unchanged at 2.5%. However, he sounded more upbeat on the economic outlook. He believed that market sentiment has improved from earlier in the year, suggesting the risks to the global outlook are more balanced. The New Zealand dollar soared after the meeting. The statement somewhat quashed hope for a rate cut soon and boosted the Kiwi.